Every single month, Wall Street just completely freezes. You know the scene, traders are glued to their terminals, just waiting for one massive data drop at exactly 8:30 a.m. Eastern Time. We are talking about the CPI report. It's an absolute game changer of a catalyst that dictates the trajectory of the entire U.S. economy and pretty much drives all stock market news for the month. So you really have to ask yourself, why does one single inflation report have the power to erase or create literally hundreds of billions of dollars in the stock market within minutes? It's a wild phenomenon, right? Within seconds of that data going live, money instantly floods between equities, bonds, commodities, and currencies. Well, today, we're going to break down exactly why this happens, the mechanics behind it, and how you can position yourself to understand these massive market swings.
All right, let's dive right into Section 1, Unpacking the CPI Report.
The Consumer Price Index, or CPI, simply measures the average change in prices that everyday consumers are paying for a basket of goods and services. Think about your actual daily life for a second. We're talking housing, food, transportation, medical care, even your clothes and your energy bills. The CPI tracks all these costs to show us the very real-world impact of inflation on the U.S. economy. It's basically the ultimate scorecard for how fast your actual cost of living is going up or coming down.
Now, there is a supercritical distinction between the two main types of CPI numbers you're going to hear the financial media shouting about. First up, we've got headline CPI. This includes the whole shebang, every good and service, including food and energy. But here's the catch. Food and energy prices are incredibly volatile. They can swing wildly just based on a geopolitical event or honestly even a bad weather season. Because of all that noise, we have Core CPI. Core CPI strips out those volatile food and energy sectors. And here is the secret you need to know. Core CPI is the specific metric preferred by the Federal Reserve when they make their long-term policy decisions. Wall Street knows this, which is exactly why the smart money watches Core CPI like a hawk.
Moving right along to Section 2, Asset Class and Fed Reactions.
Ultimately, this whole thing comes down to the Federal Reserve and their dual mandate. By law, the Fed really only has two big jobs: maintaining maximum employment and ensuring stable prices. And they define stable prices as an average inflation rate of about 2% over the long haul. Because inflation directly dictates their monetary policy, every single CPI release literally forces the stock market to reprice the probability of future interest rates. Think about it. If inflation is running way hotter than that 2% target, the Fed has absolutely no choice but to step in.
Hey, real quick, if you're enjoying this breakdown and want more market insights like this every week, be sure to like this explainer, share it with fellow investors, and subscribe to Fox of Wall Street so you never miss our latest stock market analysis.
Okay, so the absolutely crucial point here is how different asset classes react to this inflation data. When we break it down, it's pretty fascinating. Let's say the CPI comes in high, meaning inflation is running hot. Technology stocks usually take a massive hit. Why? Because high inflation means higher interest rates, which increases the discount rate that analysts use to value future earnings. This hits growth-heavy tech stocks in the Nasdaq particularly hard. At the exact same time, Treasury bonds see their prices fall, which pushes their yields up. The US dollar, on the other hand, usually gets a boost as higher rates attract foreign capital. But what if the CPI comes in low? The exact opposite happens. Tech stocks often rally like crazy, bond prices rise, pushing Treasury yields down, and the dollar often takes a breather and weakens.
And this dynamic brilliantly illustrates the whole chain reaction. The CPI outcome dictates what the Fed will likely do, which instantly flips market sentiment. If inflation is accelerating, the Fed is forced into a corner to keep rates higher for longer. That makes borrowing expensive, chokes off corporate profits, and turns market sentiment undeniably bearish. But if inflation moderates, the market instantly starts pricing in potential future rate cuts. Cheaper borrowing sparks a bullish rally in the S&P 500 and across the broader stock market. And if it just meets the target, policy stays neutral and things generally remain stable.
Let's drill down a bit deeper into Section 3, Sector Winners and Losers.
Because not all sectors are created equal when that CPI number drops. Technology and consumer discretionary, they absolutely thrive on lower inflation and lower interest rates. They just love cheap money. Real estate is in the same boat. It massively benefits from lower inflation because that drives mortgage rates down, which obviously boosts buyer demand. But then you have a sector like energy. Energy is kind of the wild card here. While its reaction to lower inflation can be a bit mixed, it actually often benefits from higher inflation. Why? Because sky-high energy costs are frequently the very thing driving inflation up in the first place.
Moving to Section 4, the Beginner Investor Guide. If you are newer to investing, these tips are basically your armor. First off, you have to understand that inflation touches literally everything. Second, and I cannot stress this enough, do not panic over one single monthly report. One hot CPI reading does not mean the US economy is suddenly doomed. Keep your eyes on your long-term investment goals. You definitely want to diversify across different sectors so you aren't completely wiped out if, say, tech takes a sudden hit. And start making a habit of watching Treasury yields right alongside your favorite stock prices, because the bond market often tells the real truth way before the stock market does.
For those of you who want to read the market just like the pros do, here is your step-by-step playbook for CPI Day. Step 1. Always compare the actual printed number with what analysts expected. Step 2. Tune out the noise and focus on core CPI over headline CPI. Step 3. Immediately check those Treasury yields. Step 4. Pull up the Fed funds futures to see exactly how the market is repricing the odds of rate cuts or hikes. Step 5. Evaluate market breadth, meaning are all stocks selling off or is it just a few massive tech heavyweights dragging the index down? And finally, Step 6. Never ever make a sweeping, portfolio-altering decision based solely on one single month's data.
Which brings us to our final and most important point in Section 5. Expectations matter most. Markets do not react to the CPI number alone. They react to whether inflation is higher or lower than economists expected. Just let that sink in for a second. You could have a seemingly terrible inflation number. Maybe inflation comes in smoking hot at 5%. But if Wall Street economists were bracing for 5.2%, the stock market is actually likely to rally. Why? Because it was better than expected. The insane market volatility you see at 8:30 a.m. is driven almost entirely by the gap between the consensus expectation and the actual reported number. It is the surprise that actually moves the needle. So, to wrap up our core takeaways for today, the CPI drives markets simply because it dictates Federal Reserve policy and future interest rates. Expectations matter most. Remember, the Nasdaq and S&P 500 are reacting to the surprise, not just the raw percentage on the page. Interest rates act like the gravity of the financial world. Higher inflation means higher rates, which violently pulls stock valuations down. And finally, successful long-term investing means you have to zoom out. Don't let one 8:30 a.m. data drop completely derail your multi-year financial plan.
So, the next time CPI Day rolls around and you see that massive sea of red or green flashing across your screens, I want you to stop and ask yourself, are you reacting to the headline number or are you looking deeper at the market surprise? Mastering that one distinction, that is exactly what separates the reactive gambler from the truly informed investor.